Hello, everyone. Welcome to this trade management mini session. My name is Barbara Armstrong. I'm a coach with Schwab, and today we're talking about long call verticals. So specifically, what in the world on long call verticals are we talking about? Well, we're going to talk about what happens if we're assigned on the short strike in a long call vertical, and also how do we calculate our return on risk and what we ultimately made on a trade. So that's our topic for today. If you're not following me on X, consider this your invitation. My handle at BarbArmstrongCS, posting content there on a daily basis that I hope you will find helpful. Know that options carry a high level of risk and aren't suitable for all investors. We did our example trades on the thinkorswim desktop platform using the paperMoney software application, which is a brilliant way to learn how to place trades and to make sure that you understand your trading plan and what you're doing. But one of the differences between paperMoney and a live account is that short options will never be assigned early, which is why we're going to discuss what a trader might choose to do, or should that happen in a live account. Okay, let's get right out to the platform. We're going to have a quick look at two examples. The first is Meta. So on September 30th, we placed a long call vertical trade. If you're not totally familiar with long call verticals, I will put a link into the Getting Started with Options class on this. I'll also put a link in to the class where this trade was placed in our Trading a Smaller Account class, so you can go back and revisit that if you like. But we placed this long call vertical trade, and here were our strikes. And just a few days later, this stock went up to over $600 a share, and it hit our profit target, which is typically set at about 50%. And we exited that position for a profit. Now, when we come to the Monitor tab and come to the account statement and look at Meta, we can see that, in fact, we did place this trade on September 30th, and we placed that trade for $2.65 per share. So that is what we were risking. How much could we have lost? The entire $2.65 a share times, 200, because each contract represents 100 shares, and we did 2 of them. So we were risking, in total about $500, $530, or, like I said, $265 per contract. Now, we ended up on October the 7th, and as part of our example trading plan, we put in a target to exit when we have a 50% gain or greater. So we exited on the 7th, just after the market opened, for $425. And so what did we make? Well, if I take the $425 and we subtract the $265, that came out to $1.60 per contract. Sorry, $1.60 per share, or $160 per contract. So our total financial gain on this was $1.60 a share times 100 shares per contract times 2 contracts. And so that was a total gain of $320 less our transaction fees. Now, how about if we express that as return on risk? Well, what were we risking? Well, we were risking $2.65 a share to make what turned out to be $1.60 a share. And as a percentage, that came out to 60%. And so it probably had gapped up on the open, and that's why we got out at a rate a little higher than what we had originally requested. Now, what if it had been assigned? And that's an interesting question. So if it was assigned, or we were, as I like to say, called out, because when we sell a call, we are saying, hey, if you'd like to buy 100 shares from us at $5.75 a share, we are happy to sell them to you. And so on this day, let's say, instead of it hitting our target, what if before that somebody said, you know what, I would like to take you up on your offer. Yeah, I am going to buy these shares from you, and you're obligated to sell them. You can't go, just kidding, I don't want to do that. So you would end up selling, you know, your shares at $5.75 per share, 200 of them. Well, if that happens, and this is certainly, expiration is the 25th, so way prior to expiration, your immediate response is to exercise your right to buy the shares at $5.70, which is what you have the right to do when you buy a call. So, sorry, you're going to buy the shares at $5.70 per share. So what's the difference? Well, so here your gain is going to be $5 a share minus what you paid to get in, which was $2.65. Sorry, $2.65. And so you ended up ahead by $2.35 a share. In other words, this is your max gain. And so, you know, sometimes being called out isn't necessarily a bad thing. We were pretty happy with a gain of $160, which turned out to be a 60% return on our risk. But at $2.35 a share, you know, that would have been even higher. You know, as a percentage, I hadn't calculated that, but 235 divided by 265, that would have been almost an 89% return. So if, and you know, this is of course prior to expiration. If you went into expiration and both strikes are in the money, then both strikes would be exercised, you know, extremely high likelihood, and you would have your max gain. But, you know, our trading plan says we don't trade these into expiration. We close them out prior to expiration. Okay, so that's the first one. The second one I wanted to look at was one that we placed on the same day, CEG. And with CEG, again, it was a long call vertical. We placed, it was placed the next day, October 1st. So we placed that trade on October 1st. It went up and hit this new all-time high. It hit our profit target and we exited the trade. Now, it turned out that was a nice thing because it's come back down to where it was trading on the day that we bought it. But if we come to our trade tab and our monitor tab, and we switch and look at CEG, we can see here that we opened this position on October 1st. We did only one contract because this is a $10 wide spread. So we were risking $5.50 or $550 a contract. We can see that on October 7th, it hit our target and we were out for $8.10. And so again, how much did we make on this? Well, there's our last example. We made the difference between the $8.10 that we sold it for and the $5.50 that we paid for it when we opened the trade. So we made $2.60 a share. And we're going to multiply that by 100 shares. So on this one, we made $260. Now, what were we risking? Well, we were risking the entire amount that we paid to get in. So we were risking $550 to make the 260 that we ended up making. And so that ended up being a return of 47%. So we like to think of that as a base hit. Now, could we have been called out on this one? Again, we could have. And if that had happened, if we were assigned or called out, if we were assigned, that means that we are selling our shares at $260. At $260 a share. And then if that happened, we would exercise our right to buy shares at $250. And then our net gain would be that $10 a share minus the $550 we paid to get in, which would be $4.50 a share, or $450. And that would be our max gain. And there's nothing, that some traders might consider more delicious than to have an opportunity to receive a max gain on a trade without even having to stay in until expiration. And I'm saying if hypothetically this had happened on October 7th, and you can be called out at any time, up until expiration. If this were through both strikes at expiration, then both sides would be exercised because both sides were in the money and you would receive your max gain. But our trading plan rules say that we do not want a trade to go into expiration. And the main reason is that there's a concern that it could pull back and end up closing in between the strikes and leave us at greater risk. So that's a wrap. These examples were for example purposes only. I hope you now feel more comfortable with the prospect of being assigned on a long call vertical, and also feel more comfortable in calculating your net gain from a monetary expense. And again, we didn't take our transaction fees into account there, and then in calculating return on risk. So thank you so much for joining me for this trade management mini session. We'll see you in a mini session coming soon. Take care, everyone. Bye for now.